Ever wondered how some investors make money when the market goes down? Or how they lock in profits before they even sell a stock? Welcome to the world of options trading, where strategy meets opportunity. So whether you're curious, cautious, or ready to level up your investing game, this video will break down the basics of financial options and how they can work for you. Well folks, Michael here. And as always, be sure to subscribe if you're not already a subscriber. It really encourages me to make more free investing professor videos. So an option is a derivative, a financial contract whose value is derived from the underlying asset, a stock, a bond, a commodity, or a currency. So you could think about it like a ticket to a concert. The ticket, piece of paper back in my day in the Stone Age, or today it's like an electronic ticket, it's not really worth anything. It's based on the actual fact that you get in the future to go to the concert. As that concert gets closer and closer, maybe the price goes up if it's in demand. So the price can change as you get closer to that concert, as you get closer to the expiry of the derivative. And there are four main derivatives. Options, forwards, which has to do with a private contract negotiated over the counter between two different parties. Futures, which are traded in a public market exchange. And swaps, which is just really exchanging cash flows. Usually debt, but it can be other things too. In this video, we're going to look at options as one of the four main derivatives. Now, an option gives you the right, but not the obligation, to either buy if it's a call option or to sell if it's a put option. How do I know the difference? I usually think of it alphabetically. B for buy comes before S for sell, and C for call comes before P for put. So a call option is an option to buy, a put option is an option to sell. So you have the right, if you purchase one of these, a call to buy or a put to sell a particular asset. Maybe it's a stock, maybe it's an index, at a particular price that you've locked in the future up until a certain expiry. Now you don't have to exercise your option, but you have until the expiry date. If you buy, for instance, an option that is 3 months hence, it could be September 1st, 2025, let's say. In that case, you have up till September 1st, 2025 to really exercise that option. It could be that you've purchased an option, a call option at 50, so you can buy at the price of 50. Even if the stock goes over 50 and it goes to the moon, you get to still buy for just 50. And of course, you could then sell the stock once you've bought it at 50 for a big profit. So you're really thinking about being bullish or optimistic if you're buying a call option. On the other hand, if you're pessimistic or bearish, you might buy a put option. You might think, I think it might actually go down. I want to make sure I insure myself. I want to get out. So let's say you buy it and the put option is at 40 and currently the price is at 50. Well, if it goes below 40, it probably makes sense to exercise your put because, for instance, if you can buy something at 30 or 20 or 10, but you can sell at 40, well, that's higher. So you can exercise that, especially when you think that the price is going down. Now, people don't just purchase these calls and put options. They sometimes write or sell these options. And by doing so, they can, for instance, they can earn rent. If you have a stock or an index, you can sell options and get the actual money from selling the options. Now, of course, now that you sell an option, you may have to fulfill your promises to the purchaser of the option, especially if the purchaser exercises it. So you could sell to earn rent. One strategy could be owning a stock or owning an index and selling some of these options on the index that you own or on the stock that you own in order to earn rent. Now, you don't have to even own the index or the stock. You could just sell the option and get that payment up front. And you can also buy something like a put, for instance. Buying put ensures you if the price drops, Or buying a call ensures you if the price rises. Because with the put, you're basically saying, okay, under this price, I'm going to be able to get out at this. So if the price drops below that level, then at least you know that you've got the right to sell at this price, even when the actual price of the stock has gone way down. You've locked in that price. That's great for insuring. But what if the price goes up? So you could buy a call option, let's say at this level, if the current level is here, you could buy a call option here, and you're basically saying, well, you know, if the actual market goes up, I want to be able to buy in. So maybe you don't even own the stock. So you don't want to put all of your capital, all your money into a stock or into a fund or into an index. So you could just buy a small little, for a small fee, you could purchase the ticket or the option to buy the stock. And so if it does go up, if it does soar, well, you're buying in at a lower level. Let's say you buy it at 60. Right now it's at 50. You buy an option for a call option for 60. So if it goes up to 70, you can definitely make your profit. Because again, you're buying at that point at 60, but you're selling for a little bit higher because the market now has gone up. So even though the market right now is somewhere like 70, you've got the right to purchase for 60, and you can get some profit right there. By exercising that, by buying it at 60, selling it at 70, of course there will be a little bit of trading fees and also the original price of the option that you paid for. So what are some excellent brokerages? In the past, I used to use a place called Options House. I've also used E-Trade. They're very much for casual traders. What I love, especially for beginners, is TD Ameritrade or now Charles Schwab. You have the ThinkScript, which is really helpful if you want to start automating your trades and coding these up. Now, Webull, sure, it's low cost, but I think this day and age, a great place to go is Interactive Brokers for more advanced and also for mobile traders. So if I had to pick right now, it'd be a toss-up between Charles Schwab if I was just starting out again, but Interactive Brokers if I really wanted to make this more serious. With Charles Schwab, you still get the ThinkScript as TD Ameritrade has switched over, but Interactive Brokers is just a very large platform and great for more advanced trading, even in futures and other derivatives. Now, as you get more advanced, you start to learn about the Greeks. A little bit too much for this video, but you can think about things like the length of time that you actually have until the contract expires. The closer and closer and closer you get to the concert, it can be good or bad. Sudden news can affect things. Just some sample trades could be, for instance, if you're a beginner, for beginners, we're more thinking about low risk, directional trades. Usually you're making these bets. So an example of a beginner thing could be like buying a stock and then selling a call option to earn rent when you own the actual stock. It's like owning a house and now generating rent on it. This is called a covered call because in the instance that the price of your stock goes above the strike price, so the strike price is the price at which the underlying asset can be bought if it's a call or sold if it's a put. If the price rises for the call above that strike price or falls below the strike price for the put. Now this is called a covered call. You can generate income, but it does cap the upside. It is great for generating passive income on stocks that you already own. Now you can also, if you've bought your stock, you can buy a put for insurance. This is called a protective put. It acts like insurance if the stock drops. This is great for hedges against downside risk. Now you can also, if you buy the stock, you can think about selling a put, but you should think about holding enough cash to buy the actual stock at that strike price for the put. Because if the purchaser of the put option that you just sold exercises that, you must be able to stand ready to meet, to buy that particular stock at the strike price of the put. This also allows you to get in cheaper. Now, you can not even own the actual stock. You can just sell a put and get money right now, but make sure you have enough money in your account so that you can purchase the stock at that particular price. And make sure you're aware of the amount of units of the stock. Usually it's in units of 100 units. So if a stock is trading for $500, you need to have $50,000 if you really want to make sure that you're not going to be caught but it does at least allow you to get in cheaper. Because right now, it could be the case that the stock is trading for $700, and you might want to wait until it drops to $500 rather than buy now. In the meantime, by selling the put, you can be earning a premium even without owning the stock. Also, as well, you're getting the stock at a discount when it falls. So it's great for buying stocks that are cheaper than the market price was when you first look at it. But it goes without saying that you really want to be holding assets that you've options on. So if you're positive about a stock, you might want to think about buying a call. If you're negative about a stock or pessimistic, you might want to think about buying a put. When you own something and you buy a put, you've insured it. It's like a protective call. In case the price drops, at least you can get out for lower than that. So you may own the stock. As it drops lower and lower and lower, you can sell it for a slightly higher price if the strike price is right. This is great as a hedge for downside risk. Intermediate strategies can be multi-leg, neutral, or range-bound bets. So you're really, a lot of the time, buying multiple or selling multiple options at the same time. Could be that you're buying one call and selling another call at a different strike price. That's a spread strategy, and you could even combine or double up on this. You could be buying a call and a put at the same time, at the same strike price. Now, for advanced strategies, you're really looking at higher complexity, precision trading. You could be looking at different terms of your option, not just the same exercise date, like a short-term option and a longer-term option. So perhaps I'll discuss more advanced strategies in future videos, like spreads. Now, one other important thing to be aware of is the difference between a naked option and a covered option. A naked option is one in which the writer or the seller does not hold the shares or the index and does not hold enough cash. This can be a little bit dangerous if the market moves against you, because all of a sudden you could have to buy somebody out with cash, which you don't have enough cash. This is where it can really wipe you out very quickly. Now, one other really big thing to be careful of is shorting or selling a call option. Here, think about it like the following. When you buy a stock, the lowest it can drop to is 0. But the highest it can go up to is theoretically infinite, right? A stock or an index can keep going, rising and rising and rising in terms of the price or the profit. So when you buy a call or buy a put, the worst thing that can happen to you is that you miss out on the price going the right direction for you between the time you purchase the option and the expiry date. So you just lose a trivial amount, just the amount that you actually purchased the option for, which is usually just a small fraction of the overall contract. When you're selling a put, it's really just the difference between 0 and the put strike price. Whereas, when you sell a call and you don't hold enough of the shares or the index, you have to actually purchase the shares or the index if the purchaser exercises their call option that you've just sold them. Well, it could be the case that the price has gone to the moon and you have to give them the stock or the index, but now you're paying at a huge price. And theoretically, that price could be infinite, right? Because the price of the stock or the index could go to the moon. So theoretically, this is where you have an infinite loss potential. So selling a call option, you've got to be very, very careful indeed. This is why naked selling of call options is usually frowned upon. So you probably should consider having the shares of the underlying asset on which you're selling the call option. And finally, a lot of the time with these options trading, your brokerage may allow you to buy on margin or buy with leverage. But here, where the price starts to move against you, you have to keep a certain amount of margin or cash in your account, or stocks or indexes in your account, and these could be liquidated. So you may get a margin call. You'll be told in advance by the brokerage exactly when that would happen, but you could get wiped out as a result. The brokerage just doesn't want to fall afoul of the law and also doesn't want things blowing up. So they're going to step in and prevent that, but that means you could lose everything. Keep in mind the margin call, the brokerage may have the right to step in and sell everything you own in the brokerage if the price moves in the wrong direction and amplifies your loss. So you can leverage or amplify or multiply your gains, but you can also lose everything and multiply your losses. So with margin trading, be very careful. Well, folks, there you have it. Options derive their price and value from the underlying asset that they are based on, much like a ticket derives its value from an upcoming concert. If everyone wants to go to see the singer, great. The value might start going up closer and closer to the time. You'll notice that ticket touters, or people that are selling tickets last minute, they can get huge fees because there's this adrenaline to want to see the concert right at the very end. Or sometimes it can go the opposite direction, right? Where some particular artists or singers lose some popularity and almost no one really wants to go to their concert, and the ticket price can drop. Or it could be bad weather, etc. So by purchasing or selling an option to buy, which is a call, or sell, which is a put, traders can earn or insure themselves if the market goes in different directions. The market can be flat, they can be earning rent. Or if the market goes down and they had bought a put, they get out better than they would have gone. If the market goes up and they bought some call insurance, they could also do better as well. And we saw here some of the best popular platforms explored some strategies that, when layered together properly, have the potential to add fuel to your returns, as well as discussing some of the dangers to avoid. So if this video resonated with you, like and comment below on any other videos or topics you'd like to see explored next.